No surprise. Traders, as I mentioned in previous video, sterling is sliding, but the real move hasn't even started yet. A trap is being set right now ahead of tomorrow's UK CPI, and if you are looking at the hourly chart without the weekly structure, you are about to walk straight into it. There is one danger zone just below current price and one hidden opportunity that could deliver 3-to-1 returns before the news even hits the screens. I will show you both. Stay until the end because I'm giving out the exact entry levels, stop placements, and 2 targets for 3 separate strategies on cable today. Write down one number right now, 1.3466. If we lose this, the whole structure shifts and this becomes a pound collapse story, not a dip buying setup instant market verdict. My session bias for pound sterling to US dollar is fade the rip, sell rallies. The 5-hour trend is decisively bearish and the daily chart is locked in a range oscillation that is getting exhausted at the top. This is a range fade with a bearish short-term tilt, meaning any push toward resistance will be met with aggressive selling as long as we stay below 1.3745. The invalidation level that proves my entire bearish framework wrong is a daily close above 1.3745. Write this number down too. If cable closes above 1.3745 on a daily candle, the sellers lose control and I flip to neutral or bullish immediately. But until that happens, every bounce is a short opportunity and every breakdown below 1.3514 accelerates the slide toward 1.3466. The asymmetry right now favors the shorts. Now let's walk through the technical deep dive because the chart is screaming something that most retail traders are completely missing. Start on the weekly time frame. Cable is grinding lower from a multi-week resistance cluster around 1.37 to 1.3745. The 200-week moving average is sitting near 1.33 and is gently curling flat, acting as a long-term equilibrium magnet. Price has been unable to sustain any momentum above the 60-week moving average, which has now rolled over and is providing dynamic resistance right at 1.3700. Every weekly close over the last 4 weeks has printed a wick to the upside that got faded, creating a series of lower weekly highs. That's pure distribution. The MACD on the weekly is about to signal a bearish crossover below the zero line, and while it hasn't triggered yet, the histogram bars are shrinking. This is the exact slow motion exhaustion that precedes a trend leg lower drop down to the daily chart. We are in a textbook range between 1.3466 support and 1.3745 resistance. Right now price is clinging to the lower edge of that range, near 1.3521, after getting rejected from the 200-day moving average. The 200-day moving average sits at 1.3680 and it's acting like a brick wall. Every single touch of that average in the last 3 attempts has produced an immediate sell-off of over 100 pips. That is not bullish behavior. The 60-day moving average has crossed below the 20-day moving average, a mini death cross that tells you momentum is decaying. The daily MACD is flatlining below zero, showing no bullish energy at all, and we are now seeing the signal line threaten to roll over again. If the price breaks below 1.3514 today, that daily MACD will turn sharply lower and you will hear everyone suddenly talking about a move to 1.3466, but by then the easy money is already gone. The institutional positioning data confirms this. Leveraged funds have been net short sterling for 3 consecutive weeks, and asset managers have been trimming long exposure into every rip. Now zoom into the 4-hour chart, where the real short-term fight is happening. The 4-hour trend is clearly bearish, with price trading below the 20, 60, and 200 moving averages all stacked in bearish alignment. The 20-period moving average on the 4H is at 1.3555. That is your first dynamic resistance. The 60-period is at 1.3610, forming a ceiling with the 200-period at 1.3640. We just had a MACD bearish crossover on the 4H and the histogram is printing deeper red bars. This is not a reversal pattern, this is continuation. Here is what most traders miss. There is a hidden negative divergence on the 4H. Price made a lower high around 1.3630, while the MACD printed a slightly higher high. That's a trap. It sucked in breakout buyers and now they are trapped. their stop losses are clustered just below 1.3514. When those stops get triggered, the cascade will send cable through 1.3500 in a matter of minutes. That is the mechanical flow I am trading against. Bring it down to the 60-minute chart for your execution precision. The hourly MAs are all sloping lower. The 60-minute 200 moving average is acting as heavy resistance near 1.3580. Price has made 3 attempts to climb back above 1.3570 and failed each time, printing lower highs. MACD on the hourly is trying to curl up from oversold territory, which could produce a dead cat bounce, but any bounce that stays below 1.3580 is a short reloading zone. The key level on the hourly is 1.3514, which is the current session low and the gatekeeper to 1.3466. If we break 1.3514 on an hourly close, the next support zone at 1.3466 gets tested within the same session. And below 1.3466, there is a huge air pocket down to 1.3350 because there is no strong structural support until the weekly volume-weighted average price of the last quarter. That's a 200 pip vacuum. This is why the stakes are so high right now. Now let's weave in the cross-asset narrative because sterling is not falling in a vacuum. The pound's decline today is directly linked to political pressure and the upcoming UK CPI, but it is also a euro relative story. Look at euro to pound sterling. It has broken above 0.8550 and is holding, reflecting a relative flow out of sterling into the euro. This is the bond spread fracture. UK gilt yields are underperforming bunds on the short end, and the Bank of England policy repricing has shifted dramatically. Market is now assigning a higher probability to a rate cut sooner than previously expected, which squeezes the pound against the euro and the dollar simultaneously. Meanwhile, the US dollar index is consolidating but maintaining its safe haven bid, and S&P 500 futures are struggling for direction. The dollar isn't ripping, sterling is simply failing. When you see a currency decline while its domestic yields dip and political noise rises, that is a fundamental short opportunity. Starmer's government is under increasing fiscal scrutiny, and the pressure ahead of CPI is not just speculation, it's a risk premium being priced out of the pound. If tomorrow's CPI prints softer than expected, expect a collapse in UK yields and a sharp downward acceleration in cable. Even if CPI comes in hot, any initial spike will be sold into because the market will quickly shift to a stagflation narrative, which is even worse for sterling given the bow's constrained position. My directional lean for the next 1 to 2 weeks is short, targeting 1.3466 first, and then 1.3350. The exact event that would invalidate the thesis is a daily close above 1.3745 combined with a break in euro to pound sterling below 0.8500. If that happens, I stand aside. Most people will skip this part, but this is where money is made. Keep watching. I'm about to give you 3 complete trade setups with exact numbers. No vague zones, no wishful thinking. Strategy 1, the sniper, conservative. This trade waits for confirmation that the range floor is truly breaking. The trigger condition is a 1-hour candle close below 1.3514 with an increase in tick volume, preferably during the London or early US session. Entry: sell stop at 1.3509 once that close prints. Stop loss goes at 1.3555, which is just above the 4H20 moving average and yesterday's intraday failed rally point. The logic is that if price reclaims 1.3555, the breakdown was a false one and sellers have lost momentum. Your target one is 1.3466, the major daily support, for a risk-reward of roughly 1 to 1.3. Target 2 is 1.3380, which is the 78.6% Fibonacci retracement of the previous quarterly range, giving you a risk-reward of 1 to 2.8. Once target 1 is hit, move the stop to break even. This setup is void if the breakout occurs during low liquidity Asian hours without follow-through. I would not take it before London Open. Strategy 2, the active trader, standard. This is a pullback short on a bounce to the dynamic resistance zone. Entry condition: Price retraces to the 1.3565 to 1.3580 zone on the 1-hour chart and shows a bearish rejection candle, like a pin bar or a bearish engulfing. The exact entry will be a limit order at 1.3575 with a stop loss at 1.3615. The stop is placed above the 4H60 moving average and the swing high of that corrective bounce. The reasoning is that if cable recaptures 1.3615, the bearish structure on the 4H is compromised and we are likely heading back to 1.37. Target 1 is 1.3514 for a risk-reward of 1.5 to 1. Target 2 is 1.3466 for a risk-reward of 2.7 to 1. Once target 1 is reached, apply a trailing stop of 30 pips on the remaining position. This setup takes advantage of the bear flag pattern that typically forms on the hourly before the next leg lower. The key here is patience. Do not chase the entry. Let the market come to you. Let's see how aligned we are. Type your pound sterling to US dollar range for tomorrow's London session in the comments right now. I'll be reading them live after the CPI reaction. Give me the absolute high and low you expect cable to print. Let's see who nails it. Strategy 3, the Aggressor, high risk. This is a counter-trend scalp from the 1.3466 support for those who can handle heat. The aggressive entry condition. Price tags 1.3466 and the 15-minute relative strength index drops below 20, indicating an oversold state, and then prints a bullish divergence on the MACD on the 15-minute chart. Entry is a market buy at 1.3475 with a stop loss at 1.3445, just below the liquidity sweep level. This is a tight 30 pip stop. Target 1 is 1.3514, the broken support turned resistance, for a risk-reward of roughly 1.3 to 1. Target 2 is 1.3555, which is aggressive and offers 1 to 2.6 risk-reward. This trade is purely mechanical mean reversion. It must be managed actively. If price stalls at 1.3514 for more than 2 15-minute candles, exit the entire position. Only take this trade if you know how to lose small and manage risk aggressively. This is not for size. This is a tactical scalp against the tide risk management pulse. Never risk more than 1 to 2% per trade. Have absolute clarity on your stop before you click buy or sell, and understand that no position should be held blindly through the UK CPI release. Stops are non-negotiable. Here is the one most critical level for the next session. 1.3466. That is the line in the sand. If we close below it on any meaningful time frame, the bearish structure confirms and we are likely targeting the 1.33 handle within a week. Tomorrow my focus will be entirely on the UK CPI print and the subsequent reaction at that 1.3466 level because that is where the real institutional flow will be revealed. I will also be updating the euro to US dollar and gold videos with the immediate fallout because of the dollar reaction. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen after this. Smash like if this analysis gave you a clear plan for sterling. Subscribe and hit the bell for daily coverage across all 8 key assets. I'll see you in the next one, where we track whether the pound collapse is actually triggered or if the trap is set for the shorts. Stay sharp.